Hello and welcome. Before we begin, I need to share something important with you. Everything you're about to hear today is general information only. It is not personal financial advice. Everyone's situation is different. Your circumstances are unique to you. So please, speak with a licensed financial advisor before making any decisions about your money or your property. All right, let's begin. Investment property in retirement, yes or no? That's the question keeping so many Australians awake at night, and I understand why. Because this isn't just about bricks and mortar, is it? This is about your security, your peace of mind, your legacy. This is about whether you'll be comfortable in your later years or whether you'll spend your retirement worrying about money. Maybe you already own an investment property and you're wondering if you should sell it before you retire. Maybe you're thinking about buying one now, hoping it will give you extra income when you stop working. Or maybe you're sitting on some equity in your family home and you're wondering if property investment is the answer to your retirement income problem. Whatever your situation, I want you to know something. Your concern is valid, your fear is real, and you're not alone. I've sat across the table from hundreds of Australians just like you. People in their 50s, their 60s, even their 70s. Good people, hard-working people, people who've done everything right. They've saved, they've paid off their home, they've contributed to their super. And yet, they're scared. They're scared that it won't be enough. And that fear, it comes from a real place. Because the world has changed, the rules have changed, and the comfortable retirement that seemed so certain 20 years ago now feels uncertain. So today, we're going to tackle this question head-on. Investment property in retirement, yes or no? We're going to look at it from every angle, the emotional angle, the financial angle, the practical angle. And by the end of our time together, you'll have a much clearer picture of whether property investment makes sense for you. Now, let me be honest with you. There is no simple yes or no answer. Anyone who tells you there is, they're either selling you something or they don't understand the complexity of retirement planning. The real answer is, it depends. It depends on your circumstances, your goals, your risk tolerance, your other assets, your health, your family situation. But here's what I can promise you. By the end of this conversation, you'll understand the framework for making this decision. You'll know what questions to ask, you'll know what factors to consider, and you'll be equipped to have a much more informed conversation with your financial advisor. So, let's start where we need to start. Let's talk about why this question matters so much, why it feels so heavy, why it keeps you up at night. Because here's the truth. For many Australians, property has been the pathway to wealth. It's been the thing that made them feel secure, the family home that increased in value year after year, the investment property that provided rental income and capital growth. Property has been the foundation of the Australian dream for generations. But now, as you approach retirement, or find yourself already in retirement, that same property that gave you security can start to feel like a burden, or a risk, or a question mark. And that's unsettling. That's frightening. Because if property isn't the answer anymore, then what is? Let me take you back for a moment. Let's talk about how we got here. Let's talk about the Australian context, because understanding where we've been helps us understand where we are now. 30 years ago, retirement looked very different in Australia. For one thing, the age pension was more generous relative to living costs. People could live reasonably comfortably on the pension alone, especially if they owned their home outright, and most people did own their home outright by the time they retired. Superannuation was relatively new. It only became compulsory in 1992, so for people retiring in the 90s and early 2000s, super balances were modest. Property, particularly the family home, was the main source of wealth. Interest rates were higher back then, much higher, but so was inflation, and property prices, while they'd been rising, were still within reach for average working families. You could buy a decent house in a capital city on a single income. Imagine that today. Fast forward to now, the landscape has changed dramatically. Property prices in our major cities have skyrocketed. Sydney, Melbourne, Brisbane. Even regional areas have seen enormous growth in recent years. And while that's been wonderful for people who bought property decades ago, it's created challenges too. Higher property prices mean higher entry costs if you're thinking of buying an investment property now. It means larger mortgages, higher stamp duty, higher maintenance costs. Everything scales up. At the same time, rental yields have compressed. What does that mean? It means the annual rental income you receive as a percentage of the property value has gone down. In the 80s and 90s, you might have seen rental yields of 6 or 7%. Today, in many capital city suburbs, you're looking at 3 to 4%, sometimes less. So you're paying more to buy the property, and you're getting less income from it relative to its value. That changes the equation significantly. Then there's the question of the age pension. The assets test and income test have become more stringent over the years. Investment properties are counted as assets, and rental income is counted as income. Both can reduce your age pension entitlement or eliminate it altogether. And let's talk about superannuation for a moment, because this is where Australia has made enormous progress. If you're in your 50s or 60s now, you've likely been contributing to super for 20 or 30 years. Your balance might be substantial. And the tax treatment of super in retirement is extraordinarily generous. Once you're over 60 and in pension phase, your super earnings are tax-free. Your withdrawals are tax-free. It's a remarkable benefit. So the question becomes, why would you invest outside of super if super is so tax-effective? Why would you take on the complexity and risk of an investment property when you could simply build your super balance? That's a fair question, and it's one we're going to explore thoroughly today. But here's the other side of that coin. Superannuation is locked away until you reach your preservation age. You can't access it before then, except in very limited circumstances. So if you're 55 and thinking about semi-retiring, or if you need income now and you haven't reached your preservation age yet, super isn't available to you. Property, on the other hand, is more flexible in some ways. You can sell it. You can draw rental income from it. You can borrow against it. It's tangible. You can see it, touch it. That gives some people comfort. And there's another factor we need to acknowledge. For many Australians, property investment is familiar. You understand it. You know how to assess a property. You know how to manage tenants, or you know how to hire a property manager. It's within your comfort zone. Superannuation, for all its benefits, can feel abstract. It's numbers on a screen, managed funds, shares, bonds, asset allocations. For people who didn't grow up with super, it can feel foreign, intimidating even. So there's an emotional comfort with property that we can't ignore. And emotions matter. They matter a lot. Because if you're going to be stressed and anxious about your retirement investments, that affects your quality of life. And isn't quality of life the whole point of retirement? But here's where we need to be very careful. Emotional comfort should not override financial logic. Just because something feels familiar doesn't mean it's the best choice. And just because something feels uncomfortable doesn't mean it's the wrong choice. We need to separate emotion from strategy. So let's get into the details now. Let's look at the technical side of investment property in retirement. And I promise you, I'm going to keep this simple. No jargon, no complexity for the sake of complexity, just clear, practical information. First, let's define what we mean by investment property in retirement. We're talking about a property that you own, that you don't live in, that generates rental income. This is separate from your family home. Your family home is not an investment property, even though it might be your largest asset. When you own an investment property, you receive rental income. That income is taxable. You pay income tax on it at your marginal tax rate. But you can also claim deductions. You can deduct interest on the loan if you have a mortgage on the property. You can deduct property management fees, council rates, insurance, maintenance and repairs, depreciation on the building and fixtures. For many years, this created what we call negative gearing. The property costs more to hold than it generates in rent, creating a tax loss. That loss offsets your other income, reducing your overall tax bill. It's been a popular strategy for high-income earners. But here's the key question. Does negative gearing make sense in retirement? Think about it. In retirement, your income is likely lower than it was during your working years. If you're living off the age pension or drawing from your super or working part-time, your marginal tax rate is probably much lower than it was when you were working full-time. If your marginal tax rate is lower, the tax benefit of negative gearing is less valuable. You're getting less tax relief from those losses. Meanwhile, you're still funding the shortfall out of your own pocket. That means cash flow out of your retirement savings every month to keep the property running. Does that sound like a good retirement strategy? For most people, the answer is no. In retirement, you want cash flow coming in, not going out. Now, let's talk about positively geared property. That's a property where the rental income exceeds all your costs, including the loan interest. You're making a profit each month. That profit is taxable income, but at least you have cash flow. Positively geared property can work in retirement if the numbers stack up. If you're generating meaningful income after tax, and if you're comfortable with the responsibilities of property ownership, it can be part of your retirement income strategy. But here's what you need to understand. Positively geared properties are harder to find, especially in capital cities. They're more common in regional areas, and regional areas come with their own risks. Lower capital growth potential, smaller tenant pools, economic reliance on one or two industries. So you need to weigh the income benefit against the capital growth risk and the location risk. Now let's talk about capital growth, because for many property investors, that's the real goal, not the rental income, but the increase in property value over time. Buy a property today for $600,000, hold it for 20 years, and sell it for $1.2 million. That's a $600,000 capital gain. Except it's not quite that simple, because when you sell an investment property, you pay capital gains tax. If you've held the property for more than 12 months, you get a 50% discount on the taxable capital gain. But you're still paying tax on the other 50% at your marginal rate. Let's say you bought that property for $600,000. You sell it for $1.2 million. That's a $600,000 gain. With the 50% discount, $300,000 is added to your taxable income for that year. If you're on a moderate tax rate, you might pay around $90,000 in tax, maybe more depending on your other income. So your after-tax gain is around $510,000. That's still substantial, but it's not $600,000. And you need to factor in all the costs you've paid over 20 years: loan interest, maintenance, property management, rates, and insurance. Those costs add up significantly over 2 decades. I'm not saying property can't be a good investment. It absolutely can be. But you need to be realistic about the true return after all costs and taxes. Now, here's another critical factor: liquidity. That means how quickly and easily you can convert your asset into cash. Property is not liquid. If you need money urgently, you can't just sell a quarter of your investment property. You have to sell the whole thing. And selling property takes time, weeks, sometimes months. You've got to find an agent, market the property, find a buyer, go through the settlement process, and you might have to sell at an inopportune time when the market is down. Compare that to superannuation. If you're in pension phase and you need extra money, you can typically request a withdrawal and have it in your bank account within a few days. That's liquidity. This matters enormously in retirement because unexpected expenses happen: medical bills, home repairs, helping family members. You need access to your money when you need it. Then there's the question of the age pension means test. This is complex, but let me break it down simply. If you're hoping to qualify for a full or part age pension, Centrelink will assess you under 2 tests: the assets test and the income test. Whichever test results in the lower pension is the one that applies to you. Your investment property is counted under the assets test at its market value. Your family home is exempt, but investment properties are not. If your total assessable assets exceed the thresholds, your pension is reduced or eliminated. The rental income from your investment property is also counted under the income test. Centrelink uses a deemed income approach for some assets, but for rental properties, they count the actual gross rental income. If your income exceeds the threshold, your pension is reduced. So an investment property can impact your age pension from both sides. It increases your assessable assets, and it increases your assessable income. For some people, an investment property pushes them over the threshold and they lose access to the age pension entirely, or receive only a small part pension. Now, you might say, that's fine, I don't need the pension. My property income will replace it. And maybe that's true. But you need to run the numbers carefully, because the age pension comes with other benefits: the pensioner concession card, reduced utility bills, reduced counsel rates, cheaper prescriptions, bulk billing at the doctor. Those benefits have real value, often several $1,000s per year. So you need to weigh the rental income from the property against the lost pension payments and lost concession benefits. Sometimes you're actually worse off financially with the investment property. Let me give you a concrete example. Let's imagine a couple. We'll call them Bruce and Jenny. Bruce is 68. Jenny is 66. They own their home outright in a suburb of Brisbane, no mortgage. It's worth about $700,000. They have $350,000 in super combined, and they have an investment property, a 2-bedroom unit in Ipswich worth $450,000. It's fully paid off, no mortgage. The unit generates rental income of about $400 per week. That's about $21,000 a year gross. After costs, rates, insurance, property management, maintenance, they're netting around $14,000 a year. That's just over $1,000 a month. Sounds pretty good, right? Extra income in retirement. But here's the problem. When Centrelink assesses them, that $450,000 property counts as an asset. Combined with their super, they're over the assets test threshold for a full age pension. They get a part pension, but it's significantly reduced. They lose around $9,000 per year in pension payments because of that investment property. And they lose access to the Commonwealth Seniors Health Card benefits, which would have saved them a few thousand more per year in medical and pharmaceutical costs. So their $14,000 of net rental income is partially offset by $9,000 in lost pension and a few thousand in lost concessions. Their actual benefit is only a few $1,000s per year, and that's before we factor in the stress of managing tenants, the risk of vacancy periods, and the capital they have tied up. Now, what if Bruce and Jenny sold that investment property? They'd receive around $450,000 after selling costs. If they added that to their super, they'd have around $800,000 in super combined. That's still under the assets test threshold for a couple who own their home. They'd qualify for a larger age pension, and they could draw on their super as needed, tax-free, without the hassles of property management. They might actually be better off financially, and they'd have more flexibility and less stress. But here's the other side. Bruce and Jenny are emotionally attached to that unit. They bought it 30 years ago. It's been a good investment for them. They like the idea of having a tangible asset outside of super. And they're worried about running out of money. The property feels like security to them. So you see the dilemma. The numbers say one thing, the emotions say another. And that's the tension so many Australians face. Let me give you another example, a different scenario. This time, let's imagine a couple we'll call Margaret and David. Margaret is 72. David is 75. They own their home in Melbourne, worth about $1 million. They have $600,000 in super, and they have an investment property, a 3-bedroom house in Bendigo, worth $500,000, no mortgage. The house rents for $500 per week. That's about $26,000 a year, gross. After all costs, they're netting about $17,000 a year. But because of their higher total assets, Margaret and David don't qualify for any age pension. Zero. So they're not losing pension payments because of the property. They were never going to get the pension anyway. Their super generates income, and the rental property generates additional income. Together, they have enough to live comfortably. The property diversifies their assets. It's in a different location. It's a different asset class. And because they're not paying off a mortgage and they're not negatively gearing it, the cash flow works for them. For Margaret and David, the investment property makes sense. It's part of a balanced retirement income strategy. They can afford the holding costs. They're not relying on it as their only income source. And they have enough liquidity in their super if they need it. So you see, there's no one-size-fits-all answer. Bruce and Jenny probably should sell. Margaret and David are fine holding. Same asset type, different circumstances, different outcomes. This is why personal financial advice matters, because your situation is unique. Now, let's talk about some other considerations. Practicalities, the day-to-day realities of owning investment property in retirement. First, property management. If you're going to own an investment property, especially in retirement, you almost certainly need a property manager. You don't want to be dealing with tenant calls at midnight about a burst pipe. You don't want to be chasing late rent. You don't want to be organizing tradespeople for repairs. A property manager costs money, typically around 7 to 9% of the rental income, plus letting fees when you get a new tenant. But it's worth it for peace of mind. Even with a property manager, though, you still have responsibilities. You still need to approve repairs. You still need to make decisions. You still need to monitor the property's condition. It's not entirely passive income. Second, maintenance and capital expenditure. Properties age, things break, roofs need replacing, hot water systems fail, carpets wear out, kitchens and bathrooms need updating. Over the life of your ownership, you'll face significant capital expenditures, and they often come at unexpected times. Do you have a buffer? Do you have cash reserves to cover a $15,000 roof repair? Or are you living month to month on your pension and super? If you don't have buffers, property ownership in retirement can be stressful. One major expense can throw your budget into chaos. Third, vacancy risk. Sometimes tenants leave. Sometimes it takes weeks or months to find a new tenant. During that time, you're receiving no rental income, but you're still paying all the costs, rates, insurance, loan interest if you have a mortgage. That can hurt. In a strong rental market, vacancy periods are short, but markets change. If there's an economic downturn in the area where your property is located, vacancy periods can stretch out. Can you afford to carry the property for 3 months with no rental income? 6 months? You need to think about that. Fourth, concentration risk. If a large portion of your wealth is tied up in 1 or 2 properties, you're concentrated in a single asset class in specific locations. That's risky. What if the property market in your area declines? What if the local economy suffers? What if the government changes property tax rules or rental laws in ways that hurt landlords? You're exposed. Diversification is one of the fundamental principles of investing. Don't put all your eggs in one basket. Superannuation gives you diversification automatically. Balanced funds hold Australian shares, international shares, bonds, property, infrastructure. You're spread across multiple asset classes and geographies. An investment property is the opposite of diversification. It's concentration. Now, I want to be fair. There are potential benefits of holding investment property in retirement. Let me acknowledge those. First, inflation hedge. Property tends to keep pace with inflation over the long term. Rents increase with inflation. Property values generally increase with inflation. If you're worried about the purchasing power of your money being eroded over a long retirement, property can provide some protection. Second, tangible asset. Some people simply feel more comfortable with physical assets. You can drive past your investment property. You can see it. You can inspect it. For some people, that's psychologically important. Third, estate planning. If you want to leave an asset to your children or grandchildren, property is a clear, tangible bequest. There's something emotionally satisfying about saying, "I'm leaving you this property." It feels more substantial than saying, "I'm leaving you a super balance." Fourth, forced savings. If you have a mortgage on an investment property, you're forced to make repayments. That's a form of disciplined saving. For people who struggle with saving discipline, that can be valuable. But here's my question to you. Are those benefits worth the costs, the risks, the complexity, and the reduced age pension entitlement? For some people, yes. For many people, no. So let's get practical. Let's talk about solutions. Let's talk about what you can actually do with this information. If you currently own an investment property and you're approaching retirement or already retired, here's what I want you to do. First, sit down with a financial advisor and run the numbers. Get a proper age pension assessment. Find out exactly how much your investment property is reducing your pension entitlement, if at all. Find out how much you're really netting from the property after all costs and lost pension. Then, model the alternative. What would happen if you sold the property and put the proceeds into your super? How would that change your pension entitlement? How much could you draw from super each year? What would your total income be? Compare the two scenarios side by side. Real numbers, not guesses, not assumptions, real calculations. Second, assess your emotional attachment. Are you holding the property for logical financial reasons or emotional reasons? There's no shame in emotional attachment, but you need to be honest with yourself about it. If you're holding the property because it makes you feel secure, even though the numbers don't support it, that's okay, but acknowledge it and make sure you can afford that emotional comfort. Make sure it's not compromising your financial security. Third, consider your age and health. If you're in your late 70s or 80s, do you really want the responsibility of property management? Even with a property manager, it's still a burden. Do you want your children to inherit that burden? If your health is declining, if you're facing the possibility of aged care in the coming years, liquidity becomes even more important. Aged care is expensive. You need accessible cash. Fourth, talk to your family. If you're holding the property as an inheritance strategy, have you actually asked your children if they want to inherit an investment property? Do they want the responsibility of selling it and dividing the proceeds, or would they prefer you simplify your affairs now? These conversations can be uncomfortable, but they're necessary. Now, if you're thinking about buying an investment property now as you approach retirement, here's my advice. First, ask yourself why. What problem are you trying to solve? Are you trying to generate income? If so, have you compared the income from a property to the income you could generate by adding more to your super and drawing a pension from it? Have you factored in the age pension implications? Are you trying to build wealth for capital growth? If so, are you comfortable with the concentration risk? Are you comfortable with the lack of liquidity? Are you comfortable with the fact that you might not see meaningful capital growth for many years? Second, can you afford it without compromising your lifestyle? If you're buying a property that requires a mortgage, can you service that mortgage comfortably? If there's a vacancy period or a rate rise, can you still manage? If buying the property means you have to scrimp and save and live frugally for the next 10 years, is that the retirement you want? Remember, retirement is about enjoying your life. It's not about squeezing every last dollar of return out of your investments. Third, have you considered the alternatives? What about investing in a diversified share portfolio inside your super? What about a managed fund focused on income-producing assets? What about simply building your super balance and living off a combination of super pension and age pension? Those alternatives might give you better returns, more liquidity, less stress, and more time to enjoy your retirement. Fourth, get professional advice. I can't stress this enough. A good financial advisor will look at your entire situation, your income, your assets, your liabilities, your goals, your risk tolerance, your family situation, and they'll build a holistic plan. Don't make a major investment decision based on a conversation with a mate at the pub or an article you read online. Get proper advice. Now, let's talk about some specific strategies that might make sense depending on your situation. Strategy 1. Sell the investment property and consolidate into super. This is often the best strategy for people in Bruce and Jenny's situation. You free up capital, you simplify your affairs, you potentially increase your age pension entitlement, and you gain flexibility and liquidity. The proceeds can go into your super if you're under the contribution caps, or into other investments outside super if you've already maximized your super. Strategy 2. Hold the investment property, but pay down any remaining mortgage before you retire. If you're going to keep the property, eliminating the mortgage improves your cash flow dramatically. The property becomes positively geared, generating income rather than costing you money each month. This strategy works best if you're close to paying off the mortgage anyway, and the property is in a good location with strong rental demand. Strategy 3. Sell the investment property and use the proceeds to pay off your home mortgage. If you still have a mortgage on your family home, paying it off should be your priority. Owning your home outright is the foundation of a secure retirement. Once your home is paid off, your living expenses drop significantly. You're not making mortgage payments. That frees up cash flow for everything else. Strategy 4. Hold the investment property, but draw on super for living expenses rather than relying on the rental income. This works if you have a decent super balance and the rental income is just a bonus, not a necessity. You're building equity in the property over time through capital growth. You're not relying on it for cash flow. And when you eventually sell, you get the capital gain. This strategy requires patience and a long-term mindset. Strategy 5. Consider a blended approach. Perhaps you sell one investment property if you own multiple, but keep another. You're reducing concentration risk and freeing up some capital, but you're maintaining some exposure to property. Or perhaps you downsize your family home and use the released equity to boost your super or pay off the investment property mortgage. Blended approaches can balance the emotional comfort of property ownership with the practical benefits of diversification and liquidity. The key is to choose a strategy that aligns with your personal goals and circumstances. Let me share one more story. A gentleman I worked with, we'll call him Frank. Frank was 63. He owned his home and one investment property, a townhouse on the Gold Coast. The townhouse was worth about $550,000 and had a $200,000 mortgage. Frank was planning to retire at 65. He came to see me because he was worried. The rental income barely covered the mortgage and costs. He was negatively geared by about $5,000 a year, and he didn't know if he could afford to keep the property once he stopped working. We ran the numbers. If Frank kept the property, he'd need to fund that $5,000 shortfall out of his super. Over a 30-year retirement, that's $150,000 out of his super, plus the lost earnings on that money. And because of the property, Frank's age pension would be reduced. He'd lose about $6,000 a year in pension entitlement. So the property was costing him $5,000 a year in cash and $6,000 a year in lost pension, $11,000 a year total. On the other hand, if Frank sold the property, he'd have about $350,000 after paying off the mortgage and selling costs. He could add that to his super. That would increase his super balance significantly, generate more income, and he'd qualify for a higher age pension. The numbers were clear. Selling made sense. But Frank was hesitant. He'd owned that townhouse for 15 years. It had been a good investment, and he was banking on future capital growth. So I asked him, Frank, what will you do if the townhouse needs a new roof in 5 years? Or if you have a vacancy period? Or if interest rates go up and your mortgage costs increase? Can you afford that stress in retirement? Frank thought about it, and eventually he decided to sell. It wasn't easy. He was emotionally attached, but he knew it was the right decision for his retirement security. 2 years later, Frank told me it was the best decision he'd ever made. He was sleeping better, he wasn't worrying about the property, his finances were simpler, and he was actually better off financially than he would have been if he'd kept it. That's the power of making a clear-headed decision based on facts rather than emotions. Now, as we come toward the end of our time together, I want to leave you with some final thoughts. Retirement is not just about money. It's about life. It's about freedom. It's about joy. It's about spending time with people you love, doing things you enjoy. If your investment property is causing you stress, if it's keeping you up at night, if it's dominating your thoughts and your conversations, then it's taking away from your quality of life, and that's not worth it. No amount of rental income or potential capital growth is worth sacrificing your peace of mind. On the other hand, if you love property, if you enjoy being a landlord, if you find satisfaction in managing your investments, then that's different. Your investment property might be adding to your quality of life, not detracting from it. The question you need to ask yourself is this: does my investment property serve my life, or am I serving my investment property? Your retirement years are precious. This is your third act. This is the time you've worked for. You've spent decades building your career, raising your family, paying off debts. Now it's your time. You deserve to spend these years in comfort and security. You deserve to wake up in the morning without anxiety about money. You deserve to make choices based on what you want to do, not what you have to do. And here's what I want you to understand. You have options. You're not trapped. If your current strategy isn't working, you can change it. You can sell that property. You can restructure your finances. You can get advice. You can make different choices. It's never too late. But you do need to be proactive. You need to face these questions head on. Ignoring them won't make them go away. Worrying about them without taking action won't solve anything. So here's what I want you to do after you finish listening to this. First, write down your concerns. What are you actually worried about? Is it running out of money? Is it losing your independence? Is it becoming a burden on your family? Is it not leaving anything behind? Name your fears specifically. Second, write down your goals. What do you want your retirement to look like? Where do you want to live? How do you want to spend your time? What matters most to you? Third, assess where you are right now. What assets do you have? What income do you have? What debts do you have? Get clear on your current situation. Fourth, identify the gap. What's the difference between where you are and where you want to be? What needs to change? And fifth, get help. Book an appointment with a licensed financial advisor. Take your notes with you. Be honest about your concerns and your goals, and let them help you build a plan. This is too important to do alone, and you don't have to do it alone. Before we finish, let me come back to that disclaimer I mentioned at the start. Everything I've shared with you today is general information only. It's not personal financial advice. I don't know your specific circumstances. I don't know your financial position, your goals, your risk tolerance. So please speak with a licensed financial advisor before making any decisions about your property or your retirement planning. All right, let's wrap this up. Investment property in retirement, yes or no? The answer depends on you, your circumstances, your goals, your risk tolerance, your stage of life. For some of you, selling your investment property will be the best decision you ever make. It will free you. It will simplify your life. It will improve your cash flow and your age pension entitlement. It will give you peace of mind. For others of you, keeping your investment property makes perfect sense. It's generating income. It's diversifying your assets. It fits with your goals. And you can afford the responsibilities that come with it. And for some of you, the answer might be somewhere in between. a blended strategy, selling one property but keeping another, paying off the mortgage, restructuring your finances. There is no universal right answer, but there is a right answer for you. And finding that answer starts with honest self-assessment, clear-eyed analysis of the numbers, and professional advice. You've worked hard for your retirement. You've earned the right to enjoy it. Don't let uncertainty or fear paralyze you. Take action, get advice, make a plan. And remember, this is your third act. This is your time. Make it count. Thank you for spending this time with me today. I hope you found it helpful. I hope you feel a little more informed, a little more confident, a little more equipped to make the right decisions for your retirement. And remember, you're not alone in this. Thousands of Australians are asking the same questions you're asking, feeling the same concerns you're feeling, and finding their way forward, one step at a time. You can too. Take care of yourself, be kind to yourself, and go and enjoy your retirement. All the best.